Wir sprechen hier am Fonds professionell Kongress mit Asbjorn Trolle Hansen. Er ist Fondsmanager des Nordea 1 Stable Return Fund. Asbjorn, in fact, the Stable Return Fund you are managing is a multi-asset mixed fund. What are the main characteristics that differentiates you from the still growing number of multi-asset products that we see in the market?
Yes, I think that the main difference is that we put risk first. So instead of building a macroeconomic scenario that could tell you where the next return is, and then allocate a lot of assets accordingly, then we at all times try to be diversified so that we can better be an all-weather fund that can both handle the next recession and the next upturn without us having to make the macro call of what really will happen. So the diversification and the risk management is something that comes first and not, as traditionally is, as a second step.
If we look at performance numbers and risk aspects, the last 3 years the fund really deserves the name stable return, the notion of stable return. Going back to a 5 years period, I could find other products in the market which have done fairly better. Is there anything important that you have changed in the strategy that explains perhaps a little bit these differences?
I think the reason that the returns might have been less is because the risk is also clearly less. So I think if you look at our historical returns, you would also find that for the last 3 to 5 years that the drawdowns have been also much less. So I think we have not a single quarter, maybe only one, where we actually provided a negative returns. So even in the period of interest rates going up in 2013 May, I think we didn't provide a negative return in that period. So I think it's again back to this, that we take risk first. We are a defensive multi-asset fund. We are unconstrained and try to maximize the risk management of the fund so that the risk-adjusted returns look, I think, quite okay. But the absolute returns will, of course, not be as high as very aggressive multi-asset funds.
You are talking about stable equities in which you invest. This expression must be your invention, I guess. But perhaps can you explain what's behind that notion of stable equities?
Yes, I think one of the things is that when you want to be defensive in a portfolio, then one of the things that doesn't work at the moment is to invest in government bonds. So rather you want to be defensive in other ways. And one of our ways of being defensive is to have our entire equity allocation going into what we call stable equities. So instead of having normal equities, so to speak, we only have these stable equities. And these stable equities are reliant on companies with stable business models, stocks with less volatility, and stocks where the earnings are not very volatile. So we call them stable equities because they have a stable business model and because also they look attractive on valuation, so that the share price performance should be stable. Mm-hmm. So in that way we improve the risk profile of the fund, and that helps the capital protection.
In the communication of the fund, you stress your aim, your goal, that the probability of a negative return in a time frame of 3 years should be in a range of 3 to 5%. This requires a robust risk management. Can you specify a little bit on that?
Yes, that is correct. That we, as a target, have to preserve capital over 3 years, and despite having almost a high weight of equities in the portfolio, then we still think we can preserve capital. We preserve capital by, first of all, diversifying the portfolio, but also by investing in high quality names like stable equities. So the low risk in the fund comes because of the high diversification and because of the high quality investing in the risky asset side, like equities where we have these 40-50%. That is really the same risk because of the high quality as maybe normal 25% equities. So the 50% stable equities has as much risk as maybe 30% normal equities, and in that way we keep the probability of losses over a 3-year period fairly low.
But perhaps a question to the development that we saw yesterday. There was the Fed decision who said that they will be going on with reducing tapering for the second time now in a range of 10 billion a month. What will that have as a consequence for a fund manager like you? Isn't it necessary to reduce that 50% that you consistently hold in the fund, because there are more and more people who are fearing that we could see a crash or a setback in equity markets?
I think the main problem with the tapering is that it's a threat to interest rates. So it's a threat to the bonds in a multi-asset portfolio of being protecting the capital. So you've got to be aware in a multi-asset portfolio what the bonds are really doing for you. So I think it actually is maybe a little bit quite on the contrary, that rather than seeking capital protection in the bond part of the portfolio, you can seek capital protection by adjusting the equity holdings to be high quality equity holdings like stable equities. And they are more robust to interest rates increase than bonds are. So actually a better way to protect the portfolio is to tilt the equity holdings towards high quality. In 2008, for example, this exactly outperformed, gave us an outperformance in our equity holdings of 20%. So the general equities in 2008 were down 40%, whereas the stable equities were down only 20%. I think this kind of capital protection will still work in the stable equities, whereas you have a problem with the tapering on the bond side.
So finally, can you give us some examples of sectors or single stocks that you are investing in?
Yes, so sectors would be typically more defensive sectors. So consumer staples has been a big part of the stable equities. It's not such a big part anymore because it's gotten too expensive, so there's a valuation risk. The biggest sector at the moment is healthcare, companies like Johnson & Johnson with stable business models, stable earnings, stable cash flows that you get at a decent valuation. Other examples are Stryker, Oracle also with a sort of mature business model with stable cash flows and earnings and at a decent valuation. So defensive sectors, but not too expensive. Healthcare, software, services, that is our big holdings at the moment.
Thank you very much for being here.